Good afternoon and welcome. My name is John Mazzara. My company is Financial Planning Associates. And today I'm going to make a presentation about IRMAA. So it's called Understanding IRMAA and its impact on your retirement. IRMAA stands for the Income Related Monthly Adjustment Amount, and it's the penalty, if you will, that you pay over the baseline premium for Parts B and Part D of Medicare. I'm going to share my screen and we're going to go through the presentation. All right. So understanding IRMAA and its impact on your retirement is what this is entitled. And we're going to cover some of the basics of healthcare in general and the obligations and why IRMAA is in place. So we're aging and growing as a population. The population of people over age 65 in Minnesota will be over 25% of our people in our state by the year 2030. And with aging comes rising healthcare costs in aggregate because as we get older, of course, we're seeing the doctor more for more things that are starting to not work as well as they used to. So rising healthcare costs with unfunded government obligations behind it. The government doesn't have dollar for dollar the money available today for the costs that they have to pay out. It's kind of a pay as you go based on revenue and taxes and things like that. There'll be increased demand and use of healthcare, again, as we get older. And over the United States, the number of Americans over age 65 is projected to increase from 58 million in 2022 to 82 million by 2050. Now, that's a 47% increase. The CBO projects that without significant changes in policy, total spending for healthcare will be 31% of the GDP, the gross domestic product, by 2035, and that will increase to 46% of the GDP by 2080. Total spending for Medicare is projected to increase to 8% of GDP by 2035 and 15% by 2080. Total spending for Medicaid is expected to increase 5% by 2035 and go to 7% by 2080. What you can see here clearly is that over the next 75 years, U.S. taxpayers face over $73 trillion in long-term unfunded healthcare obligations. And these unfunded obligations are only the ones that are driven by Medicare and Social Security. There are other unfunded obligations as well. So a little bit about Medicare. Regardless of your retirement age, benefits start at age 65. You're eligible the first day of the first month that you turn age 65. Now, if you're already receiving Social Security benefits in the month that you attain 65, you're automatically enrolled. If you're not receiving Social Security benefits, then you need to go and sign up for it. You go to ssa.gov and you sign up for Medicare, either Part A or Parts A and B. And you can do that as early as 3 months before the month of your birth. There are 4 parts to Medicare. The first one is Part A. Part A covers hospital. Then there's Part B, and that covers doctors. That's the medical insurance. Now, Part C is delivered by an insurance company. That's an Advantage plan. So if you ever hear a Part C or an Advantage plan, it's the same thing. It's basically an insurance company providing the benefits under Part A and Part B that the government would have provided, but the government has contracted with an insurance company to do it on their behalf. And then Part D is the drug portion of Medicare. Now, it may be incorporated right within an Advantage plan. So Part D could be within Part C, or it could be a standalone. Let's take a look a little more in depth at each of these. Part A pays for some of the costs involved with the hospitalization, hospice care, and home health care services. Usually Part A does not cost you anything if you put in your 40 quarters, so it's premium free. There will be, of course, copays and other deductibles that might be associated with Part A. Part B is your doctor portion, your medical insurance. It covers physicians, outpatient hospital, and certain other related services. Long-term care insurance is not covered under Part B, and there is a premium associated with it. In the year of this recording, in 2025, it's $185, but that premium varies from year to year. Part C, the Medicare Advantage plan, it's delivered again by an insurance company. Contractually, Medicare needs you to sign up for Part A and B first before you can sign up for Part C. And then they contract with the insurance company to deliver those services on their behalf. So it's managed care plans, private fee-for-service plans, and medical savings accounts. They all can work together in a Part C. It may offer extra things with Part C than you don't get with original Medicare Parts A and B. And these extras are vary from company to company, and they're not required, but of course, to be competitive, what we're seeing is that many of the companies copy each other, and if one offers that benefit the next year, another one might, to retain their customers and to attract them. Part D is the prescription drug portion of Medicare. Now, if you sign up for Parts A and B, and then you get a supplement called a Medigap policy, you may add on Part D in addition to that. If you choose not to go that route and just sign up for Part C, the Advantage plan, unless you're a veteran or unless under certain companies you opt out, then the Part D drug plan will be included in your Part C plan. Again, various companies offer various options for you to choose from with a range of premiums, and then of course, commensurate with that will be a range of benefits. Okay, there is a mandatory cost in retirement if you receive Social Security benefits for Parts B and Part D. Now, I'd mentioned Part B this year is $185. That's the least amount that you could pay. And then what IRMAA is all about, and what this presentation is about, is the extra surcharge on top of Part B's baseline premium that you might have to pay based on your income that was on your tax return 2 years prior to signing up for Medicare. Where that could be really important is if you have a large income because you sold a cabin, a business, an investment property, for example, and your modified adjusted gross income 2 years prior to signing up for Medicare was very large, then you'll have a penalty or surcharge. Now, you can request an evaluation from the Social Security Administration to have them look at it and see if they can adjust your premium, but there's no guarantee that that will happen. So back to your Part B and D premiums, they're based on your modified adjusted gross income. We're going to see some charts regarding that here in just a minute. And if your income exceeds the range of the baseline, then you'll pay the IRMAA surcharge. Now, your Social Security benefit will automatically pay for most of your Medicare premiums unless you choose to be billed separately. If your Social Security benefit cannot cover Medicare costs, including the IRMAA, you'll be billed for the difference. Your Social Security benefit right now is subject to taxation if you're earning too much income. So that's a whole nother class that I'll be doing on Social Security, and we can talk about strategies around that topic as well. Most advisors are not aware of IRMAA, and oftentimes what will happen is you'll visit with your advisor after you get this big surcharge bill, and because they don't do Medicare and are not directly involved with it, that's new to them too. So that's why I'm here today to talk to you about this, so that you can get some additional information. You can visit with me or your advisor and bring it up, and then strategize on how you might be able to mitigate it, reduce it, or even eliminate it. Many people are unintentionally, advisors are setting their clients up for losses and paying more than maybe was necessary by the timing of the sale of various assets before they apply for their Social Security benefits. So make sure that you do at least consider how selling things a couple years prior to getting on Social Security can affect the cost of your Part B and D premiums with the IRMAA surcharge. So what is it again? IRMAA stands for Income-Related Monthly Adjustment Amount. How did it all come about? Well, as of January 2007, beneficiaries enrolled in Medicare Part B with a modified adjusted gross income above a set threshold are required to pay a higher percentage of their Part B premium costs. And that's called IRMAA, Income-Related Monthly Adjustment Amount. As of 2011, beneficiaries enrolled in a Medicare prescription drug plan, known as Part D, with modified adjusted gross income above the threshold, are required to pay an IRMAA, Income-Related Monthly Adjustment Amount. So what IRMAA is then is a surcharge based on your income, and it affects Part B and Part D premiums. What is the income based on? Well, it's based on your tax status and filing of your modified adjusted gross income, referred to as MAGI. MAGI is used to determine if the income-related monthly adjustment amount applies. It's provided by the IRS on an annual basis and is generally information that is 2 years prior, but not more than 3 years for which the premium is being determined. Just a couple of examples here. For 2024, beneficiaries whose 22 income exceeded 103,000 for an individual or 206 for a joint will pay a premium amount ranging from 244 to 594. So that's inclusive of that penalty. We're going to see a chart here in just a minute. You can determine your 2024 Part B and Part D premiums by adding the income-related monthly adjustment amount to the 2024 premium costs. For 2024, the Part B premium was $174.70 and the Part D premium was $55.50. Now I'll show you 2025 next. Oh, I had mentioned earlier that you can ask that they look and readjust if you had a one-time event that you think is unusual and should be open to an appeal. You fill out a form. It's form SSA-44. So there is a form to file for an appeal to see if you can get that eliminated, the penalty, but there's no guarantee that it will be eliminated. Examples of how different forms of income can affect your modified adjusted gross income would be traditional 401k distributions, traditional IRA distributions, SEP distributions, KEO distributions, qualified annuities, dividends, wages, taxable Social Security interest, taxable pension income, rental income, and capital gains. Those are all of the components of what goes into your modified adjusted gross income, MAGI. Assets that don't count towards your IRMAA adjustment is cash value life insurance, Roth IRA accounts, tax excluded distributions from annuities, HSA distributions, a borrowing from your home equity, and a 401h plan. Projected IRMAA and Medicare increases. Well, we know Medicare and Social Security are hypothetically in trouble, meaning that they may have larger obligations and they have incomes coming in or tax revenue coming in to pay them. So in the Medicare trustee report, the trustee estimated Part B premiums would climb significantly starting in 2024 with annual projected increases. From 2024, it's going to project to go up annually 8.2% for Part B, and then from 2034 to 2048, an annual increase of 5.5%. And from 2049 to 2098, the projected annual increase to go up by 4.2%. Now let's look at Part D. These premiums follow the same time frame, 6.4%, 3.6%, and 4.5% respectively. So what we see is that they're projecting the cost for your premiums to go up significantly in the future. Imagine that, increasing health insurance premiums. Okay, so here's a comparison of what it was from 2007 to 2024, and then we'll look at 2025 next. But you can see that the Part B premium from 2007, a baseline premium of $93.50, is now $174.70. That's an 87% increase. And you can see the penalty, if you're over the baseline premium, has gone up even greater, 131% for the first bracket, 181% for the second bracket, 218% for the third bracket, and 246% for the fourth bracket. So they're raising the premium penalty for having too much modified adjusted gross income. Here's what it looks like for 2025. You can see the baseline is 106. If your income is over that as a single individual, there's a $74 penalty associated with Part B and a $14 approximate penalty associated with Part D. If you're married, that penalty kicks in after $212,000. So are you prepared for a projected 72% increase by 2033? That's why doing proper planning in retirement for healthcare and making sure that you're budgeting appropriately based on the future projected increases of healthcare is so important. So how is IRMAA paid? Well, for recipients of Social Security benefits, it's automatically deducted. So the IRMAA surcharge will be taken from your monthly Social Security payments. This deduction includes both the standard Medicare Part B and Part D premiums, plus the IRMAA surcharge. Now, the monthly impact of your Social Security check will be reduced by the total amount, or you'll be billed for it. So it depends on how you're paying for Part B and D in the first place. So it can impact your Social Security check. So what are some planning strategies? Well, I can help review these with you. What we'd ideally like to do is minimize your IRMAA required penalty by planning and selling assets or holding assets that are going to be not counted or counted at the same time that you're applying, so that your penalty will be smaller. So here are some approaches that you can use to reduce or avoid IRMAA surcharges. Doing Roth conversions and doing them earlier than, let's say, 2 years before retirement. Other forms of income management, meaning watching the flow of income and determining what years you receive them and maybe spreading them out. Maximizing other forms of tax advantage accounts, like possibly life insurance or annuities. Making charitable deductions to reduce your gross income. Tax efficient investing so you avoid capital gains. Life changes reporting, and qualified plan distributions and retirement income planning. So all of that kind of comes together at the time of retirement, when you're determining over the next X number of years how you're going to live, and making sure that you factor in your assets, the taxation upon them, and how all of that affects your Medicare planning with your Medicare premiums. So what you need is somebody, I think, that is qualified to speak to these topics and help you make the right decisions. You may have worked with an investor or not investor, a planner or investment person that helped you accumulate your assets to date, but now you may need a different advisor that can help you with the distribution from that accumulation, so that you don't end up with too much month at the end of the money or too much life at the end of the assets. Now, there's no guarantees, of course, because nobody knows what's going to happen in the future. But by being aware that these things are occurring, you might be able to do better planning now that you have some knowledge of timelines and of asset types that are going to be less impactful to the IRMAA adjustment. So I would encourage you to find an advisor that can talk to you about these topics. And that will probably involve your accountant to some degree as well, because we're not tax advisors in that sense. We're not accountants or financial advisors, or at least I'm not an accountant. The person that you may work with currently could be, but it will probably involve some strategies and some combinations and discussions and planning around this topic. So let's review. Planning for IRMAA is important because it can significantly affect your Medicare costs and retirement income. This is why planning matters. Cost impact. IRMAA can substantially increase your monthly Medicare premiums if your income exceeds certain thresholds. This can greatly impact and reduce your Social Security benefit, which you might have been planning on living on without that adjustment. So requiring distributions from your retirement accounts might be required to make up for that gap or that shortfall that you're losing now to that IRMAA penalty. So it's just kind of a compounding thing if it's not planned for. Income changes. If your income changes due to retirement, a new job, or other financial shifts, that also could affect your IRMAA. And planning ahead allows you to anticipate and adjust your finances accordingly. So with financial planning, you want to understand potential IRMAA charges so that it can help you in your long-term planning, especially when considering buying, selling various investments, how you save, and how the financial investments you look at might involve various tax strategies. We want to do this by avoiding surprises. You may have talked to some of your friends and found out that, oh my goodness, their premium for Part B and D went up. It's probably because they were not aware that selling something 2 years prior or having that large income 2 years prior would impact them. When people sign up for Parts A and B, they don't understand that that base premium that they see is the base premium, and that it'll be impacted once they sign up based on the analysis of their tax return that they filed and the modified adjusted gross income associated with that. So if you're close to various income thresholds, you might consider strategies to reducing your income to keep it under the threshold, such as adjusting retirement withdrawals or making other financial changes. Does it make sense to get a second opinion? Well, I think it does. I would be happy to sit down with you and review what you're doing and see if I can add value. So I'll have to gather some documents from you. We'll spend some time together. Visiting with me the first time is complimentary. And if I can help you adjust your income as such so that your IRMAA penalty is less, then let me help you. But I'll give you some ideas, of course. There won't be a charge for that because it's a complimentary meeting. But if we find it's a match and we want to work together, then I would propose that we may want to consider doing that. And I can help you with your Medicare choices as well as your investments and your other forms of planning. So you can review my background if you already haven't. You can see that I can offer you many, many, many different products and programs and services. So life is complicated. I can't see why you wouldn't want to get a second opinion. The worst case is you're going to find out you're doing everything correctly. And I'm going to acknowledge that what I see that you've done looks, in my opinion, to be the right thing. So having a second opinion is like, why not? I don't know why you wouldn't do it, especially when you won't be charged for it. So anyway, I'm just going to put that out there. And if that's something you'd like to do, please reach out to me and we can get that scheduled. So thank you for spending some time with me. Retirement is the beginning of a new adventure. May yours be filled with joy and excitement. With that, I'm going to say I hope you learned something and understand how IRMAA can be impactful, and we'll make steps to learn more about it and avoid the penalty if possible. Thank you. Have a wonderful day.